have the technical analysis. The technical analysis is using statistical approaches to to analyze and forecast the sentiment of the market. Okay, so there's nothing new under the sun. What has been is what will be, and the market is repetitive. Okay, because it's data. So when price gets to a point that it has respected before, it is likely going to react. All right. So you study those points, and when the market gets there, gives you a confirmation, then you use it to enter the market. And that is a more viable way of entering the market. And that is technical analysis. And that is what you are going to learn here. Okay. And most of the places that we are going to use this, this is where we do the technical analysis, the trading view. Okay. Sorry for them telling me I joined for free. I don't want to log in here. So forgive me for that. But this is where you are going to do your, let me refresh it and see if it can give me, if it can bring it back again. All right. So this is exactly where you're going to do your technical analysis, okay? Trying to see if this price that is coming, if it get to a certain point that you to respect it and go up. And that's what you're going to use the trading view, okay? So when you, so now this market, we can say that this market this side of the market is bullish, okay? Bullish means that we have the bulls and we have the bears. The bears, the characteristic, a bull will meet you and just try to head you, okay? Try to use the horns to, like the one that you're seeing on my my logo, okay? So that is the which it may change, okay? But this is the current logo. So that is the bull with the horn, okay? So meaning they're pushing the market forward, pushing the market up, okay? Then we have the bear. The bear tears down, okay? Grabs you and tears you down. So when you see the market going down, you say that it's bearish, okay? When you see the market going up, you say that it's bullish. And the characteristic of it going up is that it forms a higher high. This is a high. Then the high will come and form a low down here. I'm coming. Let me. You see the high. This is you start from here. Okay, let's start from here. So this is a high. Then the high will come and form a low. Then it will form a high, a higher high, because this high is higher than this high. Okay, so it's a higher high. Then it will come and form a higher low. This is low, but this low is higher than this one, so a higher low. Okay. Then it went up and formed another higher high because this high is higher than this one. Okay. Then now it is trying to form a lower low. Okay. This low is this low is higher than this, so it's a higher low. Okay. So now it formed, instead of it to form another higher high, it has formed a higher low. Okay. So now if this one comes to form another low and this low is lower than this, then the trend is changing and it's becoming like this one. Okay. It's becoming bearish. Okay. Because as you can see, this is high. Okay. And this is low. So this is a higher low. Okay. And this is a low. This is a low. So it's a lower low. And when you have a market with higher highs, okay, and lower lows, we say that it's in an uptrend. And if you have a market, let me show you. So you see here, okay, you see that the market is forming. Let me, so that it can be a little, yes. So you see here, the market is this is a high, it got to a high, then it came down, formed a low, but it couldn't it couldn't go and form a new high. It formed a low. Okay, then came. So this is a high, but the high is lower than this one. So it's a lower high. So this is a lower high. Okay, and it formed a low here, but this low is lower. So this is lower low. This is a lower low. This is a lower high. So it's formed another lower low, another lower high. Okay. So this is high, but this high is lower, like that. So when you have a market that is forming a lower high and a lower low, okay, we say that it is in what? It's in a downtrend or it's bearish because the market is coming down. Okay. But when you come to this side and it's now forming a higher high a higher low, okay, higher high, then higher low, higher high, higher low, higher high, higher low. Then we say that it's in what? It's in an uptrend and it's bullish, okay. But if you have it lower high, lower low, lower high, lower low, okay, lower high, lower low, okay, lower high, lower low, okay, then lower high, lower low, then you see that the market is in a downtrend. All right. So when I enter the market from here, okay, I have to specify the amount of money that I want to lose. All right. I have to specify the amount of money that I have to lose. All right. If I don't specify, all my money in my account will get finished. Okay. So there's a price that I put, that I say that, okay, when the market gets here, I tell my broker or my broker that when the price gets here, please take me out of the market. Or when I make profit up to this point, please take me out of the market with this profit, okay, or at this price. And the price that you set and you give your broker, so that the broker will take you out of the market when you're making a loss. If not, all your money will get finished. Okay. So you set a risk limit that, okay, if I get to this price, take me out of the market. If I'm not around, or take me out of the market. I don't want to trade again. That price is called stop loss. Okay. Then you also put in a price that, okay, when you get to this price, please um take me out of the market when I get to this profit level, or the market moves in my favor up to this point, take me out. That is what we call take profit. So we have the we have the stop loss. So we have the take profit. The take profit is the price that you want the broker to take you when it goes in your favor. And you have the stop loss. Okay, the stop loss or SL. And this one too can mean TP. Okay, is the price that you want your market to take. You want your broker to take you out of the market when the market moves out of your favor. Okay, so the you can use trading view. So we have long position. Long position is also buy. Long means buying and short means selling. Okay, long means buying, short means selling. So here, if I buy from here, that the market I'm buying from here and it takes me up, I've long the market. I'm long. Okay, if I come here and I sell this market, I'm short. Okay, so you can have a long position and a short position. So you can use trading view to actually set that. Okay, so if let's say I'm entering the market from here, okay, okay, I can, you see the red, this is the stop loss and this is your take profit. Okay, so I can come here and say that, okay, I want to take my profit here. And let's say my stop loss should be here. Okay. And I'm entering the market from here. So when I enter the market, if the market gets to this price and the price is 1.16377, so I'll put this one when I'm taking the trade, not after I've entered or before I enter the trade, I put in this value that I want my maximum loss that I should take. It should be at this price at 1.16377. And my take profit is 1.16819. So when the market moves in my favor like this to this point, okay, now the broker will take me out of the market with this profit. But when it moves against me, instead of it going up, it moves down. It moves down because I said I'm longing. I said I'm buying. But if it sells, okay, when it gets to 1.16377, the broker should take me out and give me the loss instead of losing all my money. Let me lose it up to here. So this is what we call a stop loss. Okay, so your stop loss will be 1.16377 and your take profit will be 1.16819. As simple as that. Okay. So you can, if this is the 1 minute time frame. So I can use the time frame. The time frame is when you go on trading view. Okay, you find it at the top here. Okay. And this is where you can use to make your analysis. We come there later. I don't use a lot of these things, but you can find out how to use them. Like I understand them, but for the purpose of this masterclass, you may not really need them. Okay. So all these are ways of trading. Okay, so if you want to find a long and short position, you can find it here. Fibonacci is also used to, it's also another strategy that people use. Okay. Yeah, I'm going to select this. Let me deselect it. Okay. Then you can have your trend lines, lines, horizontal lines to draw support and resistance. Okay. Support is a price that the market gets there and reacts, um, like it gets there and it buys from there. Okay. Then resistance is a price or a point that when the market gets to, it sells. Okay. So it's a ceiling. Okay. And this is like a floor, like that. All right. We'll get into that later, but this is just an overview. Okay. So um, the time frame, you choose your time frame based on what you want to trade or how or your intention of trading. That makes you choose your time frame. So if you want to be, we, as I said, based on the time frame, we have types of trade that gives the types of traders that we have. And um, some people will say that there are four types of traders, but to me there are five. Okay. And let me, so the types of traders, we have what you call the scalper, we have the intraday trader, we have the swing trader, we have the position trader, then we have the investor. Okay. So the scalper trades 1 minute, 3 minutes, then they enter the market to just they take advantage of the small discrepancies in the market and they go high loss size, just short time in the market and they're out. That is a scalper. You need a lot of discipline and a lot of precision to be able to trade that way. Okay. Then you have the intraday trader. If somebody trades from uh 15 minutes time frame, like takes a trade from 60 minutes, so an intraday trader will analyze the market for maybe 4 hours, okay, or maybe one day, okay, watch the market trend maybe for the day and see where the market is, drop to 4 hours, okay, to pick the direction that they will trade, okay, come to 4 hours to pick the direction, then maybe drop to 1 hour to refine the direction, okay, then they will use 15 minutes, they will enter the trade on 15 minutes or on 5 minutes, okay, and their aim is to be in the trade for the whole day, all right, but the scalper just enter for some few minutes and get out. Intraday trader wants to enter the trade for the whole day or most part of the day, and most of the time they enter from the 15 minutes time frame and the 5 minutes time frame. So if are a trader and you want to trade from the 15 minutes time frame, that's where you're comfortable. Then you're an intraday trader. So you don't use the 15 minutes time frame and you want to scalp with it, you will lose a lot of money because it takes 15 minutes. Every candle that forms here takes 15 minutes for it to develop. Okay. And the one that forms on the 1 minute, it takes 1 minute for it to develop. So that one is quick, okay, and it's good for scalpers. But if you want to sit in the market and wait for price to show direction and move, and you want to minimize your risk as much as possible, okay, you use the 15 minutes time frame. You'll be able to see some little manipulations that you can avoid, all right? Then we have the swing trader. The swing trader, take they watch the market from the 1 week. Okay, they take their they watch the market from the 1 week, take their direction from the daily, okay, which is the one day. They take their direction from the day to know, okay, this is an uptrend because the market is moving like this. It's forming a lower low, a higher low, a higher high, higher low, okay, forming a higher high, higher low, higher high, higher low. So then I'll come and wait for the market here and buy. And I'm using the daily time frame. So every candlestick that forms, it takes 1 day. So today's own is the one that is printing. It will finish in 6 hours time. Okay. Then the day will be over, then it will print. So when that is a swing trader, they don't enter short time frame, they enter longer time frames, which is 1 day. So it takes a long time for their setups to develop. Okay. And maybe they will enter their trade on the 4 hour. Some can enter on the 1 hour. Okay, some can even refine it to 30 minutes, but they don't go lower than that. Okay, and they are entering the trade to hold the trade for 3 to 5 days or maybe 1 week, and that is a swing trader. All right. Then we have the position trader. The position trader, most sometimes too, they enter on a daily time frame. So instead of them going to enter on the 1 hour or the 30 minutes, they enter on the 4 hour or on the daily time frame. So they will enter from this one day. So they will set their thing here. So when it gets there, they should go. They will not drop down to 4 hour or whatever. Okay. They have the position. They enter the market on the weekly time frame. So these are the big boys like Ryan Buffett and all those people. They are investors. They have a lot of money. So they are able to enter the market. So when they enter the market once, 5 years, they will not enter a trade again. Okay. When a swing trader enters the market, maybe 1 week or 2 weeks, they will not enter the trade again. When a position trader enters the market, the person is hoping to hold the market for like 6 months, 3 months. Okay. So they trade like 3 or 4 times or 2 times in a year. But an investor, when he enters the market, 5 years, he has not traded again. He's just waiting for the market to do whatever he does. And it's all levels. Okay. But we are now we are now in the market. We are small boys. We don't have a lot of money like Warren Buffett and the other big guys like Donald Trump and things that we trade. No, okay, we are intraday traders or we can tackle swing trading. Okay, but to be a positional investor, you need to be a millionaire or a billionaire to have that money to be able to take the shock. Well, some of us, we enter the market and in a short while, we want to get out and take the little coins that you have gotten. All right. Yeah. So that's it. So those are uh, the types of traders based on the time frame. So I've explained to you, and the time frame that you trade. So you don't mix the time frames. You have to know exactly the type of trader that you are. So if you like adventure, you like emotions, you want every day, you want your emotion, your BP to be high, up and down. You are like a deer going to drink a water full of crocodile. Okay, and you want that adrenaline. You can be a scalper. If you want minimum one, you can be an intraday trader. If you want to be more relaxed, okay, take 1 or 2 trades in a week, just and that's where the flex is, the higher you go in a time frame, the more emotional balance that you will be because you will not be putting in much stress and it will not drain you emotionally. Okay, so as a worker or someone, you should rather be focusing on becoming an intraday trader or a swing trader so that you can put one trade 1 week and you get your your money for the month, okay, or your money for the week or something if it goes in your favor. All right. So that is how it is. So I'll end here and um, thank you for joining this class, and I hope you enjoy the rest of the seasons and the rest of the sessions, and you are able to learn something great from Syndicate Trading Hub. And they are trying to make the trading very simple and very relatable. That's why I've taken my time to um, start the beginning with you. But if you know of all this, it's just a refresher course. Okay, you can move on to the rest of the courses. All right. Thank you very much. Thanks for having me and see you in the next class.